We have gone through a tightening process by central banks around the world, particularly the US central bank, the most important one of them. And we are also seeing that the world economy is slowing. I do believe that the economy that is in the deepest recession or in the worst shape right now is China. China is in a deeper recession than in probably 2008. It will come out of it, but it will be a structural problem for China for many, many years after the huge infrastructure boom and credit boom that they have enjoyed. The second deepest recession I expect in 23 for Europe. Europe is suffering from structural changes, and particularly the sharp rise in energy prices. That is not just cyclical, I think that is structural due to the geopolitical changes, due to the Ukrainian war and the dividing world into two major blocks again. We could talk about geopolitics later. But this is pushing Europe in a very disadvantaged position. And I think Europe will lose some companies, some production sites, some multinational companies moving their production sites over to other regions. And I think this is the beginning of a structural weakening of the European economy. The US is in a better shape. And when I say Europe, I also mean the UK. The UK is also in a pretty bad shape at the present time and will weaken further in the first half of next year. So all these regions that I have mentioned will be extremely weak in the first half of 2023. Now, the US is somewhat different because the US is still benefiting from the huge fiscal stimulus, the money that was spread out throughout the economy to consumers, and the consumers are drawing down that money that they had saved in 2020. And therefore, what is hitting the economy is the rising interest rates. It hits interest rate sensitive segments like housing, real estate, and the automobile sector, but the service sector is still doing well. I do believe that the US economy will also weaken. It will slow down and probably have a mild recession in the middle 2 quarters of 2023, but nothing very serious. But in total, it makes for a very weak world economy in the first half of 2023. And US investors should not take too much comfort from that because 50% of the S&P's earnings come from overseas. And therefore, I think 2023 will see a much bigger decline in corporate profits for the S&P 500 than for GDP, or than GDP decline or weakening would suggest. So that's the economic setup. What we do not know is whether there will be a credit event or not. Usually when highly levered economies weaken, usually there are some credit events. Some corporations that have an extended balance sheet and are wrongly positioned get hit, etc. I think the risk for such events is biggest in China, where the deflationary pressure from the real estate sector is very high. And we should not forget that China is highly interlinked with the world economy and also with the financial world economy. And there are still huge amounts of loans outstanding to corporate entities in China. And therefore, we do not know whether such a credit event will happen. I assume we have to expect one and what it will mean. So I think the equity markets that I have been bearish on for about a year now will hit the low sometimes in early 23, probably late first quarter, I would say, where larger trading cycles bottom. And then we have a credit event or something like that, a trigger that signals to the central banks around the world that they should ease up. that too much damage is being created out there in the world. And then I expect a change in monetary policy by the leading central banks. And that should really open the door for a better 23 for financial assets. I think bond yields have probably an open window for 6, maximum 9 months to decline. And equities will probably rally into 24 and commodities probably even into 25. So I'm warming up to a major market bottom or a cyclical market bottom and a better environment for 23 for investors. So my message is actually some pain, short-term pain first, but bigger gains later and good outlook in 23 into 24. I think the first leg up in that big cyclical rally will probably led by the growth stocks. That would be in sync with declining bond yields. And the growth stocks have gone through a very severe correction. Just ask some of the ARK investors, 75 or 78% down or something like that from the peak. So I think growth stocks will have a big bounce in the first up leg. But after that, I think the leadership will go back to the back end of the cycle, the value and cyclical stocks, and particularly energy and the metals, precious metals and things like that. That's basically the big picture outcome in terms of the economic landscape and the equity markets and interest rates. Usually we see something breaking at the end of a cyclical down market, the bear market, and usually it's somewhere in the region or associated with an industry that experienced huge excesses before. And I think China is where the biggest credit excesses have been, and where there is some real estate deflation going on, which creates deflationary problems and could lead to some shocking events. I cannot predict what and where the credit event will be, but I think it's normal to expect something along those lines late in the down cycle, because the tightening of money means that there is too expensive money or not enough money available for some of the weak guys out there.
Yep.
And then they get hit. And when that hits, that is the signal for the Fed, the message for the Fed and other central banks. Now we have gone too far. Now we have to correct, because if this goes further, then more of those entities could fall into problems, and then we have a much bigger problem on our desk.